Wealth, which is an wealth management entity which works with clients and helps them manage their investment portfolios and advises clients on various opportunities. Incred Asset Management, which is our arm which manages PMS and AIF products. Like any asset manager, they're focused on managing portfolios and getting products which are logical and suitable from client perspective. Then we have an investment banking team which basically engages with our clients on their business side and helps them on business advisory, opportunities, etc. There, that's again a very good business on the investment banking side, which works with the client to give them solutions on the business side, apart from the personal side, which we cater from the wealth management relationship management point of view. Then capital markets, that's again a very key part of our business. So we are very active debt market participant as well as a equity market member, wherein we help clients execute as well as manage their monies on both the debt and the equity markets. That's a full-fledged financial services group. Wealth management as a business and its clients definitely benefit from the whole ecosystem which we have in the Incred group to help them service and meet their requirements across the group entities which basically helps us provide a good solutions and an offer and a strong platform to our client team. Coming to the Incred Wealth business, now most of us joined Incred Wealth and like Radhika mentioned, we all have come from industry, various places. She mentioned, I used to work for BNP, and prior to that with HDFC Bank. We have a team which is all professional. Kalpesh Dave, who heads our region, Western region, he's joined us on the call now, and he used to head L&T Wealth, and before that Birla, and head client engagement, etc. on that side. So you have experienced people from the industry who have come on the platform with a whole vision to provide logical and relevant solutions to the client. It's an open architecture platform, wherein when I say open architecture, which means I not necessarily offer things which are manufactured by us. We look at the market and say who's the best service provider, who's the best investment manager, and come to you with a solution which is more logical from a client perspective. So we are more client-centric and open architecture as a service provider. Apart from that, we are technology-driven. So we use technology to enable our client portfolio management, use analytics, plus help client have a good experience with portfolios and reports, etc., which are very key for a review as well as tracking purposes. We use technology to enable our client management and investment, I would say, decision making and the speed to execute also. So that's again a key part of this thing. And like you would have heard, we are a full-fledged financial services group. So it's a full ecosystem behind the client to help him provide solutions across the businesses which we have on the financial services side. So that's a very high-level introduction on Incred Group and Incred Wealth as a business. We would definitely engage with you when we engage with you. You will share a lot more on that, and you'll experience that as we engage going forward. Coming to the point and the subject where we have really met and assembled today, which is on the market outlook and where are we headed? What's the thought process? What should one do? What's the right thing to do? Definitely, it's a very serious situation in the pandemic front, wherein it's like 1 in 100-year kind of a phenomena, and no one really knew last year what will be the right approach and the right method to safeguard yourself and then manage your money better so that you don't have challenges on the money management side, given the volatility the market is really going through. So I have Bhavna. She's prepared she has a presentation and a thought process there on the outlook side, and Akshay, who's going to share some ideas on opportunities which we feel are meaningful. I'll let them start the conversation, and I'll come back and I'll share some bits of my views on the markets, etc. So over to you, Bhavna, and later after that, Akshay will kind of add on. Thank you.
Thank you, Yogesh. A very good evening to everyone. So, a quick background: I handle the investment strategy piece for the team. The idea is I look at policy outlook, look at the macroeconomic development, not just in India but abroad as well for key economies like US, China, and Europe, and try to understand how global economic outlook and the money outlook is shaping. Because that, to an extent, given the integration of the asset classes, that definitely impacts the performance of different asset classes. So the idea is we understand what's happening on the economy front, boil it down to an investment strategy, and then that's where Akshay comes into the picture, works on the products piece, and helps us provide product which fit into the investment strategy we believe is expected to work at the moment. So talking currently about what's happening, I think the biggest piece on everyone's minds is this unexpected second wave that has caught India off guard. I mean, we are talking about 2.75 lakh cases a day, with acute shortage of hospital beds and remdesivir and oxygen and so on. So the situation looks crazy. We have seen varying degree of localized lockdowns coming into picture. Maharashtra, Delhi, Rajasthan, and a lot more other state governments have put either night curfew, weekend lockdown, or few of them the entire week's curfew. Now, the bigger question on the mind of investor and the market, it's reflecting in markets performance. To markets have been choppy. The intraday volatility has gone up significantly when it comes to equity markets, and to some extent, bond markets are also feeling that uncertainty. Now, a quick perspective I want to sort of give over here is when we were first hit by the first wave, which was February, March last year, and the entire country went into the lockdown. That time, it was like a black box for all of us. I mean, we didn't know when the vaccine would be ready, what will be the way out of lockdowns, how the economic activity would recover. And that led to a very, very sharp fall in markets. I mean, Nifty was down about 40% and so on. So, I mean, we all remember that bloodbath. Now, what happened is, coming out of that lockdown, the economic recovery was swift. This was very strongly supported by a very proactive policy by RBI, by government, and we saw it. I mean, that reflected in the market's performance to a large extent as well. Now, since this has caught us off guard and there is some set of restrictions that have come into place, we are certainly, like, the governments have been mindful that the economic activity is impacted to the lowest level in this entire situation. I mean, if we see it with other countries as well, which experience the second, third, or fourth waves, there the economic activity incrementally with every wave was lower. It was more of services and high contact businesses that they were more impacted compared to a manufacturing and other this thing. So we expect India to sort of follow that same path. We are better equipped. We'll be better equipped medically. Like, government is taking all the right actions in terms of letting vaccination open for all, allowing import, letting private sector take a bigger role. So there is an end in sight. There is a plan to end in that insight, and there is a strong policy support. So the red that we see on this slide over here, we don't expect to see that kind of red again. If anything, I mean, we will see some sort of volatility, which will be on the back of the low base in March, April last year, and to some level, the
Bhavna, we can't hear you. Hello?
and just to show you how the, can you hear me? Hello?
Yes.
Yeah, now.
Yes. Okay, super. So, I mean, just to put into perspective the kind of recovery which is reflected in the earnings upgrade as well. I mean, it's the kind of downgrade we saw when the COVID hit, and after that the earnings started seeing upgrade. There may be some bit of volatility on earnings here, but markets look at a broader horizon, broader this thing. So they won't be really bothered by a quarter or two going bad. If they see that there is a path to recovery, they'll eventually do well in the medium term. And that's where we feel this is the time to sort of make use of the volatility, enter the markets in a staggered manner. Whenever there is a correction, it's the time to accumulate from a medium term perspective. Because the, just to add to few other levers, which could bode well for the market, would be the US dollar weakness. I'm just bringing in the global outlook over here just to sort of add on to the domestic piece I spoke about. So domestically, I spoke about how there is enough policy support and enough plan of action in place for the economy to recover relatively swiftly, like it happened last time. And it will reflect in earnings as well, maybe with a couple of quarters lost. But beyond that, the overall long-term and medium-term picture remains intact in our view. The second thing is there's a huge, strong global policy support underway as well. If we see Fed, ECB, Bank of Japan, all of them have gone for significant expansion in their balance sheets. And when we talk about that in general, this kind of wave leads to a dollar weakening, which is more or less being the consensus view. And with that kind of a backdrop, strong policy in such strong policy support, MSCI emerging markets, so overall the emerging markets pack, which will include China, India, Brazil, and the other lives, continue to do better. So this is the dollar index. When it falls, MSCI emerging market outperforms US markets and so on. So we have seen that weakening streak despite the bond yields rising in US in recent times. Dollar has continued to be relatively weaker. That remains the base case scenario. So overall, as and when the economic recovery comes back in, we expect the FII flows to come back to India. We have seen marginal outflows. We haven't seen like a crackdown of outflows despite this kind of a big wave. And we expect it to come back when there is certainty on the economic piece, which should happen 2 to 3 months down the line in our view. So having said that, I'll quickly move on to the outlook for equities. So we believe that it's the economic recovery that will happen 2-3 months, like for which we'll have clarity 2-3 months down the line, lends a stable medium term point of view to the equities. And this volatility should be used to amass or invest in markets in a staggered manner, buy on dips manner. And we could look at sectors which are relatively more beaten down, provide valuation comfort. That could be financials, that could be, so financials clearly qualify for that. And the other sectors that look interesting in our view are FMCG. Other than that, we believe that auto will continue to benefit from the personal mobility piece, and then healthcare definitely, which is a more strong theme in this entire scenario. So we believe one will have to be relatively sector specific, and the stock specificity comes in. Like there has been, so Nifty had almost doubled from the lows till some time back, and there have been valuation concerns. So keeping that kind of, so even if there has been some piece of a bit of correction, there are stock specific opportunities which offer more value. So the way we recommend for equities, we divide it into 3 parts. It's a buy on dips or a staggered investments market. One needs to go sector specific or sector heavy to make better returns. And it's a stock specific markets, which can be played with good quality PMSs and so on which Akshay would be speaking in detail post I finish the piece. Quickly, I want to talk about the bond market. So talking about bond markets, this is the yield curve that's how it has panned out over last 2.5 years. So the lower end yields had been relatively very, very sticky, but they have gone up a little with the latest RBI meeting. Now, the piece here is, if we see there's a huge amount of steepness in the yield curve in this segment, this 3 to 7 year segment. So this was the yield curve before pandemic. This was last year end, and this is where we stand as of now. So this part of the yield curve has a lot of steepness. Whenever the correction happens and the economic recovery happens and the economy normalizes, this part will have to go up more than this part too for it to normalize. And that's why we believe the 3 to 7 year segment offers more opportunity to invest in. Second, there has been a significant yield compression, and that stays. So that's why we recommend, if you have a risk appetite, if your profile allows it, move down the rating curve to lock in higher yields. There's a huge yield spread in AA to single A and AA to AAA and single A to AAA. And we recommend locking in those yields by investing in company with strong balance sheets in single A rated space or double A rated space. So these are the two ways we recommend playing the bond markets here. With that, I'll hand it over to Akshay for his inputs.
I see a hand raised. I would just request if we can take all the questions in the end. We'll be doing that. Thank you. Yeah, Akshay, please go ahead.
Perfect. Thanks a lot, Bhavna. Thanks for the market view. I'll just share my screen. Radhika, is my screen visible?
Yes, yes, Akshay.
Perfect. So, good evening. Thanks for taking out time this evening. My name is Akshay Shah, and very crudely put, whatever we have as an in-house view from Bhavna, Yogesh, and myself, my job is to typically translate that into products which can be executed in a client's portfolio, keeping risk and return goals in mind. So I'll just give a quick brief as to what we do, how we do, what are the results of what we've done till date. Firstly, on the mutual fund selection process, it's a complicated quantitative model that we run to evaluate every mutual fund in the industry. If I had to actually go to the core and see what's the theory or what's the thought process behind selecting a manager on our platform, it typically would be how much is the capability of the manager to generate alpha versus peers, or on how much does the fund manager create alpha in its own category versus the peer median. And the second, where we differ very distinctly from many other boutiques or many other firms, is the consistency of alpha. So we don't really look at the fact or look at conventional measures like standard deviation. We look at how consistent a manager is in beating the peer set. So typically we prefer to have Rahul Dravid on our team, in our portfolio, versus Virender Sehwag. Both are in their own right very good players, but I think from a portfolio perspective, we need players who are more consistent. So that is the crux of what we do. Uh, what happens is that the highlight of the process is that we every quarter evaluate all the mutual funds under the universe to see which are the good ones and which are average and which are the bad ones. We have a five-star rating mechanism where five star is the top 15 percentile in each category, and going down in terms of percentile and stars, one being the worst to five being the best. So this is what typically we do as a process. What has really happened in the last 1 year is that in the last 1 year, more than selection of managers, the crux or the important decision in a client's portfolio were to actually see if you have to be invested in a particular asset class or not. So if we go like 1 year back in March of 2020, the most important decision was whether we should be allocated to equity or not. There we had a firm view that we should be allocated to equity according to the long-term allocations, and every dip had to be an opportunity to buy into the client's portfolio. What really happened, everybody knows, is there was sort of a linear recovery in the market from 7,500 to 15,400. That was the top. And we also tried to add some meaningful funds into the client's portfolio, which somewhere gave around 50% to around about 94% in the last 1 year. So this was something that meaningfully added alpha to the client's portfolio, returns to the client portfolio in the last 1 year. Secondly, while we are very strategic in our approach, we understand that equity markets are uh, ever evolving, and there are certain tactical opportunities to add to the portfolio which could also have meaningful impact on the portfolio. So last year, if I rewind to the last year again, as soon as lockdowns were announced, as soon as we saw the pandemic taking over, certain themes which became very prominent and delivered phenomenal returns in the client's portfolio. One is the technological innovation theme. So 80% of the listed market cap on tech innovation is listed in the US. So we recommended a US technology fund which could add to the client's portfolio. Obviously, people were moving and relying more on technology from in terms of work from home and other aspects. So I think this was a very meaningful addition to the client's portfolio. Healthcare at that point in time in India had a 4 year of dry run, was not doing well, was undervalued. Again, pandemic changed the face of the sector in India. So a combination of being undervalued and more reliance on healthcare, or more dependence actually boded well in the client's portfolio again. And again, we thought that adding strategic allocations in terms of global funds in the client portfolios will outperform or will do well. So hence we added some exposure there. So these themes again on a tactical level did well in the client's portfolio. On the fixed income side, what we recommended was that from a growth perspective, we knew that rates would come down to augment growth in the economy. So at the start of the pandemic is when we recommended the shorter end of the yield curve, where rates would drastically come down to support growth. Somewhere around July, August is where we saw the economy opening up and we saw certain green shoots again. So that is where we recommended the credit risk funds in the client's portfolio to capture the spread that was prevalent in the market. So we were slightly ahead of the market in terms of recommending credit risk funds because of the spread and the attractiveness, and with the view that economy would open up and start doing well again. So again, that added alpha to the client's portfolio. So this was like a year in rewind where we had a combination of strategic and tactical ideas in the client's portfolio that did well. Going forward, I would say that today, again, as Bhavna pointed out, uh, the the commentary is that we should remain invested into equities, buy at every dips, because the growth focus from the government and the numbers that we saw pre the second wave, I think look very promising in terms of sectors and companies. One strategy that we thought again would add to the portfolio of clients, or add a different flavor, is a combination of healthcare and a banking and financial services fund, a 50% allocation to healthcare and 50% to the BFSI sector. The simple principle being that, again, because of the second wave, because of the new mutant spreading fast, there will be a certain reliance on healthcare again. And in the short term, healthcare is said to be, from a market's perspective, a sort of a defensive sector. So in the short term, I think this portion of the allocation will provide stability to the portfolio and will also do well and compound at a 15-16 kind of a percentage kind of a EPS over the next 3-4 years. But in the very short term, it will give you stability. While on the other hand, we have BFSI, which has corrected from the highs on concerns of COVID. But as we had seen in the last year as well, after a steep correction, the sector bounced back very quickly once the collection efficiency and the NPA numbers really, the market had some visibility around that. So a combination of healthcare and BFSI, I think bodes well in terms of a 3-year allocation, where healthcare can give you the near-term stability and BFSI can give you a sort of a long-term growth in the portfolio. So this is something that we recommend to our clients doing right now. It's an innovative solution that can typically work well in the short and the medium term in the client's portfolio. If we just see from a calendar return perspective, I think 2019-20, these are good years to see where individually there have been some kind of polarization in the sectors. Healthcare doing mild or just about fixed income returns in 2019, whereas banking doing a 20% return. But the strategy still managed to do around about a good 13 and a half, 14% kind of a return. Same is the case in 2020, where healthcare performed well and the banking sector did not do well. So it kind of balances or counterbalances in the portfolio and can be a good strategy. Secondly, I mean, apart, and these are opportunities that we think apart from the core core strategic allocation in the portfolio, we think these are certain strategies that can be executed. One being on the unlisted space. So we have a fund called the Roots Venture Fund. It's based, or the main premise of the fund is that there is a rise in consumer discretionary or discretionary spend in urban cities in India. So to take advantage of that shift in consumer behavior and sensitization in consumers' mind, there's a fund which captures that. It's on the unlisted space with a minimum ticket of 1 crore, which is sort of rarely seen in a private equity kind of a fund. The portfolio is a 7 year, or the strategy is a 7 year strategy with 18 to 20 investments in the portfolio. As we speak currently, the portfolio is actually valued at 1.3 to 1.5x, but available to investors at par. So this is a bigger advantage, where in a private equity fund, you know the portfolio beforehand, and the portfolio through further rounds has been marked up to actually be valued almost 30 to 50% higher from the original investment amount, and still available at the original investment amount. So again, this typically is a strategy, or is a meaningful addition to the client's portfolio, where there is certain amount of diversification from the listed universe, and still you tend to play the urban consumer discretionary story in the country. Lastly, we've been, I think, from the later part of last year, on a calendar year basis, we've been saying that when fixed income yields bottomed out, I think clients who were reliant on fixed income had to take a call, because the post-tax yield on conventional fixed income really did not beat inflation. And they had to add certain meaningful exposure of credit to the portfolio. As you can see, conventional categories today also, and on post-tax basis, really don't beat inflation, and hence adding some bit of credit or measured exposure in the portfolio is something that one should look at. Uh, I'll just present one opportunity from Incred itself. Is the NBFC arm of Incred. It's a NBFC with 1,000 crore kind of an equity exposure and 1,600 kind of debt. So it's a 2,600 crore AUM company that we have on the NBFC side, predominantly in the retail space. We've come out with a innovative fixed income based MLD product, where if Nifty doesn't fall by more than 75% in the next 18 months, client gets a 10% kind of a yield on an IRR on the portfolio. So as I pointed out, conventional fixed income is not really beating inflation. So there are certain innovative fixed income products on the short term which need to be looked at least till the rate reversal cycle takes place, and post which it can be again deployed there. So yeah, this is it from my side. These are a few ideas that we typically have. I mean, Kalpesh and team can definitely engage on a personalized basis to see what suits your portfolio, but these are broadly thoughts that we have on the product side currently.
Yogesh, we can't hear you. No. Is your laptop on mute by any chance? No, you're not audible. Yeah. In the meantime, I think if any of you have any questions, you can please use the Q&A box at the bottom. Or, of course, I mean, raise your hands and I'll unmute you. Let
Audible now?
Yes, yes, Yogesh.
Okay, great. Sorry for this tech issue. And thanks, Akshay Bhavna, for the insights. Uh, so I think we'll like to keep this interactive, and hence we try to limit our presentations and views shortly to 5 minutes. I'll request everyone to log on the questions, and in the meantime, I'll just give my 2 bits on how do we really approach the entire investment process and what's our outlook which we hold on our markets, and a quick summary of the same. So as I said, on investment what does a investor seek and objectives are, what's his risk profile, appetite. So the starting point is we like to understand each and every investor on what's his objectives, what's his risk profile, what does he look to achieve, what's the time horizon of investment. Those are very basic questions we like to understand, and what has been the experience on various investment opportunities in the past, and so on and so forth. So once we have that information and idea and a right profile of an investor, then we go back and look at opportunities and products which we have and we think are meaningful. So the second data point which we look at is, where does the current market look? How does the current market look like? What is the best possible way to meet a client's objective? So is it a fixed income instrument? Is it a equities? Is it international equities? Is it just to make available liquid funds so that it's a cash management requirement which a client is looking to meet and fulfill? So these are the kind of second stage, I would say, checks which we do on what's our market outlook and what are the opportunities, and then engage with the client and identify what they like to pursue and invest in, then monitor the investments on a regular basis. So that's like an investment process which we have defined to offer suitable products to investors based on their risk profile, based on their investment profile, objectives, etc. Coming to the outlook per se, if you ask me, when the markets really moved up after the first round of COVID in last year, March, we did see a lockdown got announced and the market really had a huge fall. If you remember, September is when the Indian COVID situation peaked out. So September was a high of infection rates and the death rates in India. And after that, we've been seeing a steady decline from September to December, Jan. And Feb was the lowest point of the first wave, which we see. But if you remember, right from a March lows, the market created a low on the March after the lockdown announcement. And from that point, it was inching up. What was market looking at? Market was looking at what's the situation likely to be 3 years, 3 months down the line, 1 year down the line. How's the situation evolving? How's the vaccine coming up? How's the medication therapies coming up? Is lockdown really helping to control and curb infection rate? So as and when markets got comfortable with that, it started inching up and it moved up well before the infections peaked out. Why does this happen? Markets work on an anticipation. They really don't look at a news today. They started declining much before the second wave really started. And you've seen a continuous decline from a 15,500 Nifty levels to 14,200, 300 odd levels, which we see stand at currently. And there was no, I would say, a strong reason for it to move up so sharply. And at the same time, on an anticipation of a second wave picking up, you did see a correction well before the second wave has really come in. And we are yet to hit a peak. As the India, various states get into a lockdown mode, you'll see a peak of infection later. But markets would not really worry about that. Markets will look at what's the vaccine announcement, what's the availability of vaccine likely to be, what's the case fatality rate, etc. And how quickly will we go back to normalcy. So it works on an anticipation, and markets will probably take a view some point in time in the next few weeks that everything should be okay after 3 to 6 months. And based on that, you will see the trend resuming and subject to the corporate earnings really stacking up and the demand really not getting impacted, which is our base case. Our base case view is that people will come out and spend and buy what they need to buy once the COVID situation normalizes. So that's a base case view, and I don't think there is any. We have seen that recovery being very sharp after the first wave. After the second wave, also we'll see the recovery in consumption demand and discretionary consumer discretionary demand being very strong. So as we stabilize, you will see things improve and stabilize. What it also does is it puts the entire monetary system, the government, the stimulus, the RBI on alert, and they are all out to support the economy, support the corporate earnings growth, support the demand. So what this means is you have, along with while the market, the demand will recover, you have all these enablers and stimulus and monetary policies which are loose enough to keep the things good and supportive, so that demand and economic cycle recovers quickly, and we really don't have a long-term impact. So that's a very good, I would say that's a silver lining, wherein you have monetary policy as well as government being supportive and will help out in the economic recovery. So that's how it will play out. What we feel is this decline, our outlook, like Bhavna mentioned, is that we expected the markets to be in a range. Now it's coming closer to the lower side of the range, and rather than being fearful now, one has to stagger out investments. We are not saying, see, one can never get a bottom, what's the right point and what's the lowest point of the market. But as we really, as the situation evolves, you will see markets finding support at some point in some time and some levels. So accordingly, one has to stagger investments and look for opportunities. And that's where, if you see Akshay's presentation, we've tried and find out sweet spots. So when the first wave came in, we focused on some international opportunities, some very large global technology giants. In the second wave, we're talking about a banking and a healthcare fund combination, which will basically help us have a bellwether portfolio, which can easily sustain any kind of market volatility. So we have to be a little more opportunistic and stagger investment. And I'm sure over a period of 2 years, the portfolios will look good. So I think I'll pause here and I'll see if there are any questions, and we can look to answer that and try and make this a little more interactive.
Yes, there are a few questions which have come in, Yogesh. The first one is essentially saying that the IT results have been phenomenal, and IT is the biggest contributor for jobs and the economy in general. So, what are your views on the sector, considering it's a defensive sector?
So technology definitely has a is on a structural path which is up after not okay. The need for technology and the speed at which it needs to be implemented and evolved uh, uh, has really gone up multifold after the COVID situation. Everyone's BCP, business continuity plan, backup plan, digital as a mode has really gone up as every business's thing. So I remember when the first wave came in, everyone was struggling to have a right digital mechanism to handle clients and manage investments and manage various opportunities. All companies really struggled. And how do you ensure that, how do you make a ecosystem available to a employee of the office and work from home? How do you have this technology platform wherein we can have a webinar with everyone rather than a banquet hall or a hotel room? So all that things, technology became a huge thing. And after the first 3 months, you did see everyone getting comfortable with the technology and using it a lot more. Every organization increasing the spends. So the spends have really gone up. IT companies are recruiting. Wage inflation is back. Most of the companies have come out and said openly that they would like to increase the wage to attract talent, retain talent. So all these are very positive sign. It's a structural growth. I haven't seen a company, every company is evolving their processes, their requirement for IT, they're improvising their user interfaces and processes, etc. So you will see a constant and a continuous demand for that thing, right from a digital to a process improvement. And hence it's a very structural story over a multi-year. Is it a good time to enter or not a good time to enter? If you ask us, valuation wise, it's really moved up. The problem is when everyone realizes it's a great story, you don't get the stocks cheap. So when everyone realized FMCG was a great story, you had to buy it at 40 times multiple. Okay, IT is not so expensive still, but yeah, it's still a free cash flow company. And can it command a premium like an FMCG can command? Potentially, yes, but I would say there is still some time away for that. So given the sharp run up in the recent past, I would still suggest a staggered investment, but yeah, definitely a structural story over a longer period.
So I think any fund recommendations in the tech sector? I think
Akshay, you would like to add that?
Yeah, so we don't have many dedicated tech funds to choose from. Tech, although as an allocation has ramped up in diversified portfolios, but from a fund perspective, a dedicated category for tech, not really many choices there.
Edelweiss US Tech would be something, or
That would be a US tech. India IT will be a little different there.
the next question is going by the current wave of new infections and deaths, it appears that this quarter is over and even the second quarter may be massively impacted. And then the US yields rising may prompt action on Fed liquidity, and that could cause pain for emerging markets. Your
So,
views on
yeah, yeah, gloom and doom. Everything looks is how you look at it. But yeah, there are two, three questions. I'll take it one by one. Yeah, second wave will have its impact. Will the growth forecasts and projections get toned down? Yes, certainly, and it's happening. You've seen economists pull down their estimates on the GDP forecast. Corporate earnings may not be similar what probably they would have indicated earlier, a quarter back when the COVID 2 was not really on the radar, the second wave. Yes, it will have an impact, but does it mean, see, like I mentioned, stock markets work on an anticipation. You're seeing markets down at least 10 plus percent or 8 or 9% from a top. And but if you look at stock levels, the stocks are down 25, 20%, 30%, depending on which sector and which stock you talk about. So you're seeing the markets really factoring in that kind of an impact on a quarter earning already in the prices. So it's all in the price, firstly. Second, markets work on an anticipation. They are not really pricing in this quarter's earning, which is likely to be bad. If I look at the price damage, they're really pricing in a one full year's earnings being bad. So once you have some certainty of a peaking out of infection and opening up, starting again of the economy, you will see markets reducing their extreme view of earnings being impacted for more than one quarter or two quarter to something which is lower. It can be a quarter or so, and really the results will say a lot. We're in a result season, so it's a thing which will play out. I think it's a lot in the price, and once the market gets a feel of second wave peaking out, you will see things improvise much before they show up in the results. Second point on the Fed rates moving up and sorry, US yields moving up, and how will it impact Fed actions and how will it impact emerging markets? So if you see Bhavna's presentation, our entire firstly, U.S. government is sorry, U.S. Fed is guided very clearly that they're going to be supportive and they'll wait for an actual data rather than what you call the yields to determine the next rate move or a liquidity wind down. They're likely to be supportive for multiple quarters. It's not like a very short thing. They've been comforting the market on the same. And US yields have been higher since a quarter now, and we have not seen the U.S. markets really give up. They're still at an all-time high. So liquidity unlikely to be changed as a scenario, and second wave and fourth wave and third wave are still a discussion in every large economy in the world. And that being a case, you would not really have any central banker remove liquidity very quickly. It's going to be very it's going to be anything which it's likely to be FY20, CY22 and beyond. It's not likely to be CY21, calendar year 21. Emerging markets will not, more than liquidity, they work on a dollar view and liquidity certainly, but dollar view also. So our sense there are multiple factors which will keep the dollar weak. A, printing of the money, and B, entire. I mean, if you look at the printing of the money is the highest correlation to what the dollar depreciation is there. So all that factors being in place, we don't anticipate any huge risk. There will be volatility. There will be bouts of capital moving out, capital coming back, basis short-term movement. But if someone has to take a structural call over the next 3-5 years, I would say there's a strong reason to stay invested and take a structural call over 3-5 years. Can the market have a volatility of 5-10% in the interim? Certainly it can happen. It's not like markets will never trade at a fair value. It will always trade at a higher expensive valuation or a very cheap valuation. So one has to really see. And the more uh, policy rates are lower, policies are supportive, liquidity is ample, you will see rates being low, and rates being low means there is no alternative to improvise return but to take risk. And that's where you have a demand for risky assets, which is emerging markets and other equity options which you have globally.
Thanks, Yogesh. That was a detailed response. The next question is, what do you advise on the debt side in these times?
Sure, Akshay, you like to take that?
Sure. On the debt side, I just go back to give a brief background, and then I think it will make more sense. So last year we saw the short trend of the curve coming down from around high of around 7.5 to somewhere around 460, 470 as being the low. While that part of the
Yeah,
yield
you
curve
might just
came
need
down.
to be a little louder, please.
Can you hear me now?
Yeah, better.
Yeah, so the shorter end of the yield curve typically came down rapidly from 7.5 to 460. So we saw a huge decline there. But the longer end, typically the 7 to 10 year, that portion of the yield curve really did not come down so much. So hence we saw a very steep yield curve. Now, as we stand today, I think the best opportunity that the investor has is in the 5 to 7 year range because of two reasons. Is one is the carry is higher in the 5 to 7 year range, and even if there is a sort of a rate action again on downward side due to higher duration, the investor may benefit. Even if there isn't any rate action on the lower side, again due to a higher carry is where the investor benefits. That is one portion. The second part on the fixed income side is adding select credits into the portfolio. That could be through a credit risk fund, or that could be through some short-term papers in the range of 2 to 3 years from selected issuers, where there is a good yield available, and the investor is confident. I think these are two pockets that we are typically looking at on the fixed income side, which are attractive.
Add, I can't, can you hear me now? Okay. To add my two bits on that, firstly, on the fixed income side, the quality segment, which is AAA, etc., is very finely priced. So you have levels which are closer to 5%, etc., on 3 year tenor, and AAA bonds, etc. AA and AA minus segment is still offering some value, and you can improvise yields and returns there. Credit risk funds are a good option as you earn better carry yield, and hence your portfolio returns will be better. And like Akshay said, anything which is what you can where you earn 7-8% and higher, depending on what risk you want to chase. We're comfortable with the credit risk environment. We are not very worried because that Indian corporates have gone through a huge deleveraging in the last 2-3 years First you had the NBFC crisis, and then the COVID crisis. So anything which was bad is already there in the is out, and anyone who is troubled and can't raise money is anyways got impacted. And only the stable and the quality corporates are improvising and getting money. So that being a case, you should be fine if you pick up a good, strong balance sheet, strong company. And just because their ratings are down, that doesn't mean they don't. They're not. They have an insolvency risk. So the insolvency risk is very low in a strong balance sheet company. And that being a case, if some people want to take slightly higher risk, there is a decent amount of uptake in yield, which is about 9%, which can be possible on credit side.
Yes, I think if you get in touch with our relationship managers, they'll be able to share some of these opportunities with you. The next question, Yogesh, is metals are coming out of a long slumber. Do you think this will continue? If yes, how can one participate in this theme?
I'll tell you, more than getting into sectors and everything, I would encourage everyone to have a very diversified portfolio. Uh, while we have views across metals, IT, pharma, everything, the reason why we picked up banking and a pharma together is because we wanted to give exposure to two sectors which we feel have a long-term impact after COVID, and one because of a valuation being attractive, and healthcare because of a tailwind, and the entire thing about medical infra and health being in focus in after this pandemic. But to get into every sector and execute metals, you can't execute it without a fund. You will have to buy a single stock, which I feel is a lot more risky than buying a fund. B, while we are positive on it, we don't know how much to allocate because it's a lot more volatile. So can I give a generalistic view saying that you should have 5% of the portfolio? Not really, because it's a lot more volatile sector, and it can also lose money for clients if you get caught on a wrong side of a cycle. It's a cyclical. So a cyclical, you need to have an entry point and an exit point. So while we can talk about an entry point today, if we don't speak, say, at the right time, and we don't help you move out at the right time, you may not really make any returns or lose money also. So I would say any cyclical single sector, single stock, I would avoid, and I'll prefer a diversified portfolio. And even a fund manager of a diversified portfolio, if he has a positive view on metals, he's going to have an allocation to that segment. So it gets addressed and it gets managed at a portfolio level. And I think that's will play out across market cycles, and a lot more logical approach, I would say.
Thank you. I think we've covered all the questions so far. Kalpesh, would you like to come in and maybe share what's on the minds of clients?
Am I visible?
You're audible, but we can't see you. Hello?
Yeah, one second. Okay, I don't know why the video is not getting started. Okay. Thanks so much for Bhavna, Akshay, and especially Yogesh. I just like to add a couple of one, two more worries that we come across usually when we talk to clients. One is a fear of obviously the market downside, and second, obviously the fear of missing out, the upside. So, which, as you rightly mentioned, on the by a strategic asset allocation and a staggered investment, one can address it. However, would like to just have another point of view also on that, which is where a lot of passive funds are taking importance. So the first part of the question probably would be on the lines of how do we address the fear of downside and a fear of missing out together. Second would be the passive funds gaining a lot more importance. So how do you address that?
So all valid questions and investors' dilemma. To put it straight, there are a couple of things I think no one really can achieve on investments. A, catch a top. B, catch a bottom of the markets. And the best way to kind of time matters. Staying invested matters. Second, to time the markets is very. I mean, it's pointless. So the way to handle it is staggered investments. You have options of weekly investments, monthly investments. So one can really go as fine as that, and stagger investments over a period, and that's the best rupee cost averaging one can do. So not get worried about whether markets are on a high or a low. Second is definitely a valuation parameter. So if I look at the valuation parameter, markets were trading at a significantly premium compared to the historical averages. That premium has got reduced, and it's got I would say it's come back, reverted closer to the mean, not exactly on the mean right now. It still trades above mean, but it's come down significantly, and it's become fair at the moment after this correction. And as we go ahead and start discounting earnings of FY22, etc. So you also have to track the valuation parameters. So given the valuations have come off, and markets are volatile, a staggered investment, okay, staggered cannot mean it's staggered for a 3-year period or a 1-year period. So if you see after this correction and a valuation being attractive again, I like to stagger it within 3 months. So I'm saying 3 months, and within 3 months, I like to get deployed and get benefited as the corporate earnings recover over a longer period. So that's one approach, a disciplined investment approach of staying invested longer time, following valuation matrix to figure out when to reduce allocations and increase allocations to risky assets, and having a diversified portfolio. Not equities is what matters. One should have right amount of fixed income, right amount of private equity, and so on and so forth. International investments, we strongly recommend at least having 10 odd percent in global or international funds. Why do we say that only Indian markets can give you that return? US has proven it, saying that last decade it was the best performing country as well as sector on the IT side, technology side, and has given phenomenal returns. So you have diversification available globally through in India. So diversification globally and fixed income and having exposure to all these asset classes will also improve the investor experience on in the portfolio. So that's the few bits on that.
Thanks, Yogesh. I think we have one more question or two more questions. What's your view on real estate as there is sudden traction seen in that sector? I know it's again a sector-based question, but if you want to address.
It's gonna be use based. So the only post-COVID piece is that because you are seeing a lot more people being at home, so there's certainly the requirement of space, a bigger house has really gone up. Not only Bombay, across, so people are looking to upgrade, and that really demand has picked up. Or people who are on the rent, a lot of people have moved back to their towns and now working from there. So the entire sector has gone through a change after the COVID situation. That's a residential sector. So residential sector, certainly there's a demand uptick. A lot more people who are on the sidelines have come out because of better deals, etc. Now, what does it mean? See, the best way to invest or benefit from a real estate cycle uptick, one can buy a housing finance company, or one can buy a pipe company, and a ceramic company, to benefit from a home improvement as a theme. So there are multiple ways, or a cement company to play out that view. But yeah, definitely real estate is looking up. We have to still wait for a lot more data. Affordability is still a question in some of the markets, not all the markets, and that one has to really watch for. But yeah, certainly the demand has picked up after a very long time.
Thanks, Yogesh. One more question is a little more on the maybe Bhavna will have to cover this, but how is the vaccination percentage differential, and how will it play out for the Indian economy? I'm not sure whether it's talking about the differential in terms of the efficacy or the gap in the vaccination.
I think it's a vaccination implementation. Bhavna, you want to take that?
Yeah, I mean, I'm just trying to interpret the word differential over here. But having said that, I'll try to provide some answer to that. So, I mean, going by the current pace, if we were to take it as a base case scenario, it's expected that to cover 75 to 80% of our population, let's say, to assume. I'm like talking very base numbers right now. I'll try to give more perspective to it towards the later part of the answer. So we'll take around 2 to 3 years doing simple maths, saying we are vaccinating 20 to 40 lakh people daily, administering that kind of doses to get to 75 to 80%. It'll take about 2 to 3 years, and that really sounds huge. I mean, that makes you question how long would the economy take to recover. Now I want to bring into the perspective the way government is trying to sort of accelerate this number. This is by bringing in other foreign players like Sputnik, Pfizer, Moderna, and Novavax, etc., and then allowing a larger private sector participation. The news that came in just about yesterday, that they will help Bharat Biotech and SII increase the capacity, as well as allow these players to price it differently for people who want to pay, and that will in the end economically create more capacity in the system. So having said that, with private corporations coming in, the pace would pick up from here. So there are different estimates on the street, like street estimates, and there are different reports available. So when we go by that, it looks legible that by December 20 we'll have a fair amount of vaccination in metros, which will allow a fair amount of opening up in the economy. See, it's a more of a metro problem, because this is where you have congested housing, you have congested travel system, and that's where the social distancing becomes a problem. So you need to shut down. So this is, and plus government is definitely ramping up the hospitalization piece and all. So given that there's a plan of action in place, and the government was quick to acknowledge the lacuna that existed few months back, that 2 to 3 year number will definitely shrink down to 1 year in our view. Now, second piece, if you're talking about the differential of efficacy, I just want to highlight one study by WHO, which says that AstraZeneca, which in general after a 4-week gap gives a 63% efficacy, goes up to 80%, 82% after 3 months. So, I mean, there are mutants in the play, there are other various factors in the play. So, really getting that herd immunity will help us deal with the differential of efficacy of vaccines that are being administered in the developed economies and over here as well. So I really hope that differential piece in these two interpretation gets answered for you. In case Yogesh or anyone else wants to add anything, that'll be, yeah, open for you.
All good, Bhavna.
I think no further questions. So I think closing remarks, Yogesh, from you.
I think there are a lot more opportunities, and people have to have an open mind. There are risks, but there is risk in everything, and it's just that we have to figure out what's our level of comfort, what's our risk appetite, and select opportunities accordingly. But yeah, if you're chasing a 10, 11, 12% return, then we will have to start getting comfortable with a little more risky, relatively risky opportunities. Equities is not a bad asset class if you're willing to give it time, stay invested across market cycles. There's a lot more returns to be made there. One has to just really be a little more patient and give it time. So I would say happy investing, and we would like to speak to you guys individually through our relationship managers and help you out.
Thank you. Thank you so much, Yogesh.
Thank you so much, Yogesh. Thanks, Akshay. Thanks, Bhavna. Thanks, Radhika, for addressing this webinar. Thank you, all the participants, all clients, for sparing some time. We, with the entire team, will be more than happy to be in touch with you and would like to have more such interesting sessions. Thanks a lot for your time.
Thank you. Thank you so much, all of you.
Thank you, everyone.